Let's talk about this rally because it's certainly feeling like more than just a little bull trap. There was lots of bullish progress made in the supporting evidence categories last week I need to show you today, but the daily higher low is really what we need to become more confident in a trend reversal. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So let's kick things off on the SPY monthly time frame chart now that the October bar has officially closed out. And from a structural perspective, what we'll notice is that it's an indecisive doji with a bearish edge, a red-bodied bar closing under the opening print, of course. But the most fascinating component is actually the lower wick. If we do something like this, we can start to talk about the monthly higher low thesis, which really relies on this as a monthly inverted head and shoulders, breaking the neckline here and coming in for a retest, right? What was once prior support way back here turned to resistance, plenty of times to produce the neckline. And now it's very possible that we could use that area on a retest as potential support. And on the monthly time frame chart, of course, if we're counting trend, we have lows, higher lows, and this would be a very logical place for the next higher low in the overall trend sequence. If you're thinking about highs, we've just pulled back from the higher high in this sequence right here. I certainly would not argue, obviously, that is a lower high from the all-time high to what we got this past summer, but nonetheless, in this sequence, we are pulling back from a higher high, so it's very logical to look for a potential higher low, and once again, that lower wick is starting to indicate that. Now, again, we can't ignore the upper component or the fact that it's a red-bodied bar, so I'm not calling for new all-time highs. I'm not even calling for an equal high to back here, but as of right now, the monthly higher low is certainly starting to attempt to be found in this general zone. Why else is it so important? Well, we know that there's lots of confluence. If we come in with an anchored view app from the all-time high, as well as the October low, what you'll notice is if that would register, let's take another try there we go. You'll notice that we undercut it and we technically close the monthly bar above. It begs the question, if stronger sellers were truly getting involved in this market at this particular location, don't you think that on a breakdown through those key anchored view apps, we would get a close underneath or at least closer to that inflection point? It was not the case. We can also take out the Fibonacci's from the October low up to the most recent high, and what you'll notice is the same thing on the 38.2. There's an undercut of that 38.2, but technically the monthly bar closes above. The last point of confluence is coming in with a volume profile from the all-time high, extending out to current traded prices. This, of course, as we know, is a high volume node. It's actually the point of control of this segment of price action. So once again, is it logical that at all of this confluence and structurally relevant area of prior resistance, which can now act as support, that buyers are trying to step up, and that's what we saw in the lower wick? To me, the answer is absolutely, and all of this aligns with the monthly higher low thesis we've been describing for the past couple of weeks, it feels like. Let's take a look at the weekly time frame chart, speaking of, and what you'll notice over here is that we certainly have a solid green-bodied bar last week, and it's very, very impressive because I can almost remember word for word saying, because we just produced a weekly lower low, it would be very unlikely that the weekly trend would neutralize over the span of one individual week. I probably put the drawing in that an equal high being produced here would be a very low probability outcome, and leave it up to the market to prove me wrong. We of course produced some sort of equal high here on the weekly time frame. So the trend is starting to neutralize even on something like the weekly. Clearly, there's been a strong response back up and over the weekly 50 SMA. That's the blue moving average on your screen. And we're coming in for a back test of a very important area right here. Remember that the weekly downtrend was really kicked off because we had highs, lower highs producing a double top, and when we broke down through that neckline with the help of the FOMC, that certainly kicked off a lower low. It was then used as a lower high in the general sequence. So this is a very important structural area for the market to resolve, and we really want to see prices above that if we would be more confident in a weekly trend reversal. What I think is a little bit more likely to happen is some sort of pullback off of this level, and considering the magnitude of last week's bar, it's not likely, again, maybe I'll bite my tongue this time around, it's very unlikely likely that we would trade all the way back down to an equal low. If we do, it speaks to volatility in the market, and then it's just kind of a hang on tight. It's really not a healthy indication if we see a weekly bar like this and trade directly back down to the equal low. But taking that sort of out of the picture, if we do produce some sort of higher low, you could start to envision how the weekly trend changes after a higher low and then breaking this for a higher high. That's really what we're looking for here, to be more constructive and to say firmly, yes, the monthly higher low is on the table, and we will start to look for resumption of the secular uptrend on something like your monthlies after some sort of sequence like this. So just to be clear once again, it looks like that. Inverted head and shoulders on the weekly. We'll talk about where that right shoulder wants to be on the daily chart in just a moment. But before we go there, a couple of confluence points. Let's come in with our Fibonacci's from here to here. What you'll notice is from the top to the bottom of this pullback, we are right back at the 50% mark, for the most part, in 1 week's worth of trade. Very, very impressive show of strength from the buyers. We'll talk about gamma squeeze as well on the daily chart in just a moment and how that played into it. And then we'll also take an anchored view app from the tippity top, and what you'll notice is that's exactly where we're at. So for now, I think it would be reasonable that a little bit of a pullback now could produce a weekly higher low off of this confluence as resistance. We look for the weekly higher low, and then an equal high breakout really reinforces the monthly higher low thesis. Let's move on down to the daily. Let's begin by evaluating this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. It was a great excuse to use the 16 delta method this weekend with thinkorswim down and not having their handy calculation. If we're contained by the upper bound, the number is 442 flat. That, of course, would imply some sort of higher high. If we're contained by the lower bound, the number is 427.50, and that, of course, is a major higher low. So the expected move this week is definitely bullish. The next thing that you'll notice here is that the expected move is extremely compressed as compared to what we had over the last 3 trading weeks. And that's of course because the VIX volatility index has ultimately crushed as this has moved in the upward direction so rapidly. So volatility is coming out of the market, even though it looks like we're gapping up sporadically here, right? We basically went for a 3, maybe even 4 sigma move last week, but volatility is technically coming out of the market, and that's why you're seeing a reduced expected move. In terms of trend here, obviously we're looking at a, I would argue, technically neutral trend with an equal high-ish being produced here, but coming from a lower low. Remember that we did technically have a soft set of lower highs here. And I'm not really comfortable saying that we have a break to a major higher high because we never actually moved into an hourly uptrend here to confirm this as a strong daily counter trend move. Instead, this really feels like one consecutive move in the downward direction. So again, trend here has been neutralized. And I want to talk about where we get involved in trends because there's been a lot of just back and forth about this, right? Shorting at the lows, short in the hole as we call it, is never a good trade location. Just like as we head into this coming week's worth of trade, being long at the tippity top of the move after a 100% retracement of the downdraft is usually not good trade location, all right? So yes, there is bullish momentum in the upward direction. Is it responsible to be chasing new money longs up here at the very top of this move as we come into a structurally known area of resistance? I would argue the answer is no. And yes, the expected move would suggest there is some room to move in the upward direction. I would much prefer to look for a healthy pullback on the daily time frame chart to really give us more confidence in the reversal that we've been discussing so far in today's video. As you can probably imagine, just sort of superimposing the weekly time frame or even monthly time frame chart, something that produces a weekly higher low anywhere above this area right here, that's 421.25, looks really constructive for a daily higher low. We trade back to the equal high. Now we have a daily uptrend, and then we're looking for a break of those equal highs, and now we're in a weekly uptrend, right? So that's the sequence that we're really looking for as we move forward here. Of course, it would be irresponsible to not at least talk about the gaps underneath us. These will be downside targets on pullbacks this week. It's plain and simple. There's thin structure in the market. Underneath 433, the gap closes to 431. That's Thursday's high. And underneath Thursday's low at 426.50, the gap closes to Wednesday's high, and that's here at 423.25, also confluence with your daily 200 SMA and quite close to the key area of weekly support where we want to potentially look for a higher low. So if the market does decide to break down aggressively this week, if we see a loss of the hourly uptrend, and we'll take a look in just a moment at the hourly, if we see that, this should be top of mind. If we can hold here on the daily, things are still looking constructive in the upward direction. Let's take a look from a Fibonacci perspective on the daily. if we come in from the low to the top of this counter trend move, what you'll notice is that your 38.2 is perfect confluence with the top of the gap from the Thursday morning gap up here, and also extremely close to the lower edge of this week's expected move. So that would be a top of mind area if we start to pull back from this as a daily inverted hammer. If we break down underneath that low, look to close the gap and then potentially move further to Thursday's lows. That would be the primary place on the daily, but once again, we know there's wiggle room towards this area right here. If we do start to break in the upward direction, if the gamma squeeze continues, notice that the retest of your daily double top neckline is the next overhead target at 443.25, and that is extended technically through the upper edge of this week's expected move. Once again, I would be extremely cautious about looking for new money longs as we enter those new prices above the top of this prior range here. On the hourly chart, you can clearly see the 100% retracement, and I just want to illustrate that one more time because it's never ideal to be chasing new money longs at the tippity top of that move. And what you'll also notice is that this, of course, has kicked off from an inverted head and shoulders back here. We broke the neckline, produced a higher high, and then we started to see gamma squeeze in the upward direction. If you're not familiar with what gamma squeeze is, it's when everybody goes out and buys calls. Who sells those calls? The market maker, right? So they're technically net negative delta, and to neutralize their delta, because they never make money directionally, they make money on the spread, they want to go out and buy 100 shares of the S&P, or they go out and they buy ES futures contracts, right? And that continues to put upward buying pressure on the market. It's like a vicious cycle. It's a positive feedback loop. And that's really what causes these aggressive moves in the upward direction to the magnitude of a 3 or 4 sigma move like what we got last week. So it's reasonable to expect if that's going to unwind or even settle down just a little bit, we could come in and close some of these gaps. And the reason the gap closes are important is because they offer potential hourly higher lows, at least in reference to the Friday gap up, right? If we pull back and do something that looks like this and then bounce off of that area, technically, this could be an hourly higher low. But if we just find an equal high and pull back again to produce an equal low, all of a sudden a breakdown through that turns this into a double top. You can see where I'm going, right? Lower high underneath, and now we're aiming for the daily higher low at 421.25, which keeps the weekly inverted head and shoulders in force, which, as we know, keeps the monthly higher low thesis in force, right? And when we get here on the hourly chart, you want to see an hourly trend reversal. Double bottom, it could also look something like an inverted head and shoulders here, almost a mirror of what we had down here at the very bottom of the move from 2 weeks ago now at this point in time. So you get the idea for a pullback. If these gaps start to close and then we find lower highs underneath them, that would really lead me to believe that 421.25 could be on the table as a pullback zone. Now, what you'll notice is it is technically extended through the lower bound of this week's expected move. But if we throw on a couple of things here, let's go ahead and put on an anchored view app from the very bottom of the move. Notice that you get confluence here. This is the main level that I'm starting to think very, very aggressively about at 423.25. Daily 200 SMA, gap close from all the gaps would be closed. This structure would be repaired and this structure would be repaired, and it's also your anchored view app from the low of the overall move, right? If we take out the Fibonacci, we know that technically speaking, the 38.2 as we saw on the daily is up at the beginning of the Thursday low, right? But look at where your 50% retracement is, also offering confluence around this particular level, around 423.25. So I'm very interested in that as a potential pullback here on the hourly, and we've walked through how that could unfold, either a double top up here or even just a lower high, right? Let's say that we close the gap, find a lower high underneath Friday's low, underneath a backtest of our daily 50 SMA. That could also kick off the hourly downtrend to ultimately achieve that 421.25 that we're looking for in the first place. If the market does continue in the upward direction, just remember, once again, it's very, very difficult to chase new money longs up here, but if we do continue, ultimately what you're looking for is a break and a higher low, very tight higher low, up and over 437 flat. That way you can clearly define your risk and your reward is very expansive. The only reason to take trades up here on the higher high is, number one, if the momentum continues in this market and you have tight risk, those are the only two things, momentum and extremely tight risk. If you have both of those components, it's definitely worth trying to take a stab at it, just because, once again, in this case, you're risking something like 1 to, I don't know, maybe 5 or something like that if we do ultimately make it up here. But just understand where you are in the trend sequence. If you're missing momentum, if you're missing a tight stop loss, this trade, you should pass on it 10 out of 10 times. Let's take a look now at some supporting evidence. Market internals are going to look a little bit different on TradingView, but check out the video tutorial in the top right-hand corner if you're not familiar with this screen. For the most part, you can clearly see on the Thursday and Friday session the absolute domination from the buyers. If we just look at our substantial reads on an individual day perspective, I mean, look at Thursday, just a blowout day, far, far above our 300 million in the upward direction. Same thing with Friday even, and the cumulative build on the week. The net flows, very, very substantial. If you take a look at the open on the Friday session, what you'll notice is that our breadths were actually double digits. We had double-digit breadths on Friday. Very, very impressive reads, and also it just speaks for itself. It's clearly buyers in control from a volume flow perspective. We could take a look at the advanced decline line, ignore these studies underneath for now. What you'll see here is that we were definitely in and even above trend higher zone on the Thursday and Friday session. Throughout the week, we were slightly lower in the earlier stages, but this is total over-correlation in the upward direction. It's very unsustainable to have readings up and over 2,000 in the advanced decline line. So once again, this would actually tie in beautifully to looking for a pullback on the daily or hourly charts to get us out of this over-correlated state. Lastly, we'll take a look at the tick, and we will throw on this as a cumulative study. What you'll notice is that the builds are substantial. Remember, we made a comment on Wednesday that these were okay. They're definitely more bullish than bearish, but it was nothing to write home about. Look at the sustained buying pressure throughout Thursday's session in particular, where that gamma squeeze really unfolded. So if we're just looking at the cumulative builds, this would certainly align with the buyers being in control, and even on Friday, seeing follow through right into the end of the day with just a mild pullback into the close. Maybe some people taking off weekend risk, not wanting headline risk. Very, very reasonable. So internals definitely support this turning into something that is potentially more than just a bull trap. Market profile is always Exhibit B. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. Of course, given the gap ups, it is going to look a little funky this week, but here is Monday and Tuesday's session. Remember that on Tuesday, value area and point of control certainly push higher in the overall range. Wednesday's breakout is an end-of-day push producing a little bit of single prints right here. Value area and point of control were lower. So it means one of two things. Either nobody wanted to transact up here, or longs were positioning at better trade location and didn't get head over heels into the close. Now, if we take a look at the rest of the week, this is where things become really revealing as to where major inflection points might happen. We have a poor, or I would just say lack of material excess at the low of Thursday's session. So if we interact with Thursday's lows, I would say that the gap close is definitely in play underneath that area. Notice that the value area and the point of control migrate higher with price on that individual session. Okay, next day, Friday, it's also a gap up, but notice here that the value area, and more importantly, the point of control, so the purple line is always half back, right? And point of control is right at half back. So if we open underneath the midpoint of Friday's range, in my eyes, longs with terrible trade location from up here are likely to close out, noting once again that they've basically bought the highest high, the top of the move. If they close out, if they have a stop, let's say underneath Friday's low of day, that spurs your first gap close to get to the Thursday high of day. So I'm really paying attention to where early on Monday we open. Is it above Friday's point of control or below Friday's point of control? If below, I would have more of a reason to believe that the pullback could be in play to at least close the gap to Thursday's high. Changing gears over to the QQQ monthly time frame chart, you can clearly see a very similar bar as to what we discussed over on the S&P, with a slightly larger upper wick, which might seem bearish at first glance, but think about where we are from a location point of view, just not even close to the monthly retest structure for that higher low zone we were discussing on the S&P. Now, don't get it twisted. Of course, from here to here, we have an even better monthly higher low. So it's not that the trend has been jeopardized, but instead of thinking about it as a retest, I would much more prefer to think of this as just monthly bull flag consolidation. And if we're talking about bull flags, it's very classic and typical to bring out the Fibonacci's from the low up to the top. As long as we're over the 38.2, it's ideal bull flag consolidation. And you can see that the lower wick of October never even interacted with the 38.2 from that perspective. If we bring out our anchored VWAPs from the all-time high, as well as the October low, not even close. And if we bring out the volume profile from the all-time high over to the current price data, we are right back at the high volume node. It is possible that we could find some sellers here. We could find a little bit of a rejection here, but it begs the question, if we closed inside of the low volume void from over here, because if I extend this, you can see that technically the monthly bar closed underneath. It begs the question, why were stronger sellers unable to rotate through the thin volume void, or at least close deeper within it for the rotation to the next high volume node underneath, which is much more in alignment with the monthly higher low structure, the same retest area area as the S&P. So batting bullish here on the monthly time frame chart with much more so a look like a bull flag. Let's go to the weekly time frame chart, and you can start to see that same exact range we've been talking about a couple of times now, how this was look below and fail. This is definitely look below and fail with a firm weekly close underneath. Once again, sellers unable to materialize on a close in an area of really thin structure, right? That monthly higher low structure is way down below at 320. There was not much going on here to provide potential support. So the fact that we've rotated back into the overhead range does strike me as being more bullish than bearish. Now, if we take out the anchored view app from the tippity top of the move, you'll notice we're right at that area. So would it be reasonable for a pullback here on the weekly? Absolutely. Let's take a look from a fib perspective from the high to the bottom. We're actually over the 50% retracement, which is better than the S&P. So it goes to show if we do see a pullback over in the NASDAQ, it would be very reasonable to look for that same weekly structure, but even better of an indication would be your inverted head and shoulders with a higher low back within the overall weekly balance range. Of course, the target would just become the top of the range. So let's move on down to the daily and get more granular. So this week's expected move for the QQQ is up to 376, of course, implying a higher high here or down towards 359.50, a major higher low over here, and also almost confluence with the beginning of the gap from Thursday's morning session. If we are thinking about trend here, we're a little bit lower than an equal high, so not willing to say that we're completely in an uptrend or even in a neutral trend yet. You would want to see a little bit of continuation. Equal highs closer to 373 become a little bit more comfortable to make that statement, but the flip side of the coin, of course, is just that any higher lows can easily be produced, and that, of course, would start your daily uptrend as well. From the weekly perspective, the line in the sand that we were just referring to is going to be right over here. As long as we can hold up over 354.50 on any pullbacks, you're really looking at a daily higher low and a more firm weekly inverted head and shoulders to kick off maybe a monthly trend reversal. Obviously, your equal high break would have to be up and over that 373.50 mark, and then you're going to start to trade towards the top of the overall range. Your last target overhead that's at least in play this week, if we do see upward continuation, is around 377.75, the flat top from back down over here. Notice on Friday we did recapture our 50 SMA. That does strike me as bullish, but once again, thin structure underneath was caused by a gamma squeeze, and it wouldn't be unreasonable to unwind some of that and look for an hourly trend reversal. On the daily chart, let's first take a look from a Fibonacci perspective from the lows up to the very top of this move. 38.2 is not really confluence with anything, nor is the 61.8, but if we were to get a partial gap fill, right, just to sort of put this one on the table, remember what a partial gap fill always represents, and this is something that you can carry forward even for the S&P, right? If you get a partial gap fill, it would represent that the sellers are weak, because technically speaking, there's not much structure in here that's going to prevent the sellers from pushing price through that. So if we do see a reversal, either sellers are weak or buyers continue to remain incredibly strong here, looking for a daily higher low if that 38.2 holds in confluence with your lower edge of the weekly expected move. Let's get that off the screen and move on down to an hourly time frame chart now that we know our ups from downs. Similar story, almost a 100% retracement, not all the way there yet over in the NASDAQ, but we are technically looking for an hourly trend reversal to kick off a deeper daily pullback. That might look something like this, then a breakdown through the daily 50 SMA to get to the top of the gap, and then we can close that gap, and as we know, this is the do or die zone for the daily and weekly time frame around 354.50. You can see how this trend ultimately kicked off in the first place. Ascending triangle breaks to a new higher high, then we're off to the races. So once again, this is kind of the path that I would look for if I was a pullback player. Break of this neckline, trade to here, that would be your first target, and then through the gap is your next target. And then as we approach this area, certainly thinking about hourly trend reversals, if your daily higher low is going to hold around that 354.50, then retrading back for the same upside targets. The primary one would be wherever the hourly trend reversal stemmed from. It would be the neckline of a double top, neckline of a head and shoulders, wherever that is. It doesn't have to be here around this gap area, but that would be the major next battleground if we get a daily reversal around that 354.50. If the market is to move in the upward direction, I would not be aggressive into that 370.50 flat top from over here. I would be thinking about maybe a sweep of that area and then back down underneath for the hourly pullback to begin. Then you're looking for your first higher low, right? If we do get a move through it, again, don't push your luck up here. You really need momentum or a very, very tight stop loss to try to get involved in the upward direction. Let's take out our anchor view app from the very bottom of the overall move. Where is that? It's giving you plenty of wiggle room to look for that daily higher low around that 354.50. Let's take a look at the supporting evidence. NASDAQ internals look extremely similar to the NYSE with very strong reads on the Thursday and Friday session. Maybe not as extreme, but definitely a strong cumulative build. Net flows on the week were definitely positive and very strong inflows from a ratio perspective on Thursday and Friday as well. Not quite double digits, but definitely something to write home about. Something that we haven't seen in quite some time was reaching up and over 4 to 1 positive on the NASDAQ. Moving along to the advanced decline line, you can see that we're well extended through our trend higher zone here and here. That, of course, is overcorrelated and once again would align with looking for a pullback first and not being giddy about new money longs at the very tippity top of the move. Let's take a look at the tick here, and we will just throw on our cumulative, and we will make sure that this is adjusted to, what do we have for our tick Q? There we go. And it's almost identical. There we go. There's that little negative swoop from the Wednesday session, but look at the Thursday and the Friday. They really speak for themselves. Once again, the internals across the exchange really do support the move that we saw in the upward direction. Now it's all about confirming it with a higher low on the daily. Market profile for the NQ looks fairly similar, but what you'll notice is this is Monday and Tuesday, so fairly straightforward. Wednesday with the end of day breakout, right? Value area is still lower, so is the point of control. Thursday, same old song and dance. Value area and point of control do migrate higher with price. We do have an incredibly poor high on Thursday, but look at Friday with the point of control actually up towards the top of the overall range. So I think it would be even more likely that there's an opportunity to open underneath that point of control and trap longs late to the party here, looking for some sort of pullback in the NQ may be more reasonable than the ES, just noting that the point of control is ultimately higher. If we do gap over that point of control, gap rules would tell us to generally look for a fade first anyways. So in my eyes, the NQ, watching very closely, if we open underneath 15,190 basically, any opens below that, and I would tend to think that overhead supply can start to sell and cause a little bit of a pullback. And lastly, for the broad market, how about the IWM Russell 2000 small caps monthly time frame chart? Solid red-bodied bar, not a substantial lower wick to read into from a structural perspective, but as you can see, we are starting to line up already a candle with a similar size body in just the first couple of trading days in November. So is it possible that we could be due for a counter trend move? One thing we talked about on Wednesday is that it's very rare to see a protracted period of 3 months or more of downside for the Russell. The last time we really saw something like that was over here during the sickness crash. We have roughly 3 periods that are down over here, a couple periods that are down over here, but notice the range is very similar. We are also coming into an equal low on the monthly, so could that hold? It's possible, but we're still looking for mostly a counter trend move only until proven otherwise, specifically in the Russell on the monthly, because we have a failed breakout which started way back over here. If we bring out the anchored view apps from the all-time high, as well as in this one, we don't even want to come from the October low, but the sickness low from way over here, we're underneath both of those. The monthly 50 SMA is potential resistance there. If we bring out a Fibonacci, let's come in from the all-time high to the low of the most recent move. Obviously, even if we move to the very top of this consolidation here on the monthly, we're underneath a 38.2, keeping bear flag consolidation in place. And then lastly, we will throw on from the all-time high to the current trade price. What do we see from a volume perspective? We are at the high volume node on the retest. If we start to break back down towards these lows, there's really not a lot beneath us. If we take this from a little bit further, let's go from the sickness low to the current price and see what we get there. Yeah, notice that this really is the highest volume location. If we start to break down underneath, things get pretty thin from that volume perspective. You're really just dealing with thin structure all the way closer to 150. It's not quite a threat right now considering what's developing, but let's move on down through the time frames, go to something like the weekly here and see what else we can learn about the potential structure on the weekly time frame chart. Big reversal so far in the upward direction, but it begs the question, is this just a counter trend in the overall downdraft? And to me, the answer here is yes, and more definitively a yes than what we have over in the S&P and the NASDAQ, because on the Russell, as long as you're underneath the neckline of this as a weekly head and shoulders, you really haven't done much to reclaim the bulk of that monthly range, this range right here that we've been talking about. So as long as we're getting a lower high underneath the midpoint of the range, weekly 50 SMA, head and shoulders neckline retest, it's very difficult to look at this through the lens of a constructive move in the upward direction. direction. A couple of other perspectives. Let's, of course, come in with an anchored view up from the tippity top. We're still underneath that. That is a bearish indication. We'll also come with our Fibonacci from here to here, and notice that you're coming right into the 38.2. So if we do start to pull back here and do something like this, now you're just building a weekly bear flag in the context of a monthly bear flag. And as we talked about, breaking down underneath this low leaves the door open until 150. So plenty of downside here over in the Russell 2000. Let's go to the daily time frame chart, and we'll jump on to our drawing set here. And what we have from this particular point of view is, once again, just a gamma squeeze in the upward direction, two very aggressive gaps that make up the bulk of the move higher. The expected move this week would suggest, though, a reclaim of this fairly important level. That number overhead is 180.25. You are getting fairly strong resistance, I would argue, around that 176.85 is what that should technically be. You guys know the rules up here. Let's go 185. As long as we're underneath that, it's very difficult to once again say anything constructive. You would need a higher low, and even then you're just coming in. So here's the illustration, right? There's your higher low, there's kind of your inverted head and shoulders. What does it give you from a weekly perspective? Maybe a back test of the head and shoulders neckline, right, at 182.25. That's the weekly level that really needs to be reclaimed if anything more constructive is going to happen in the upward direction, and I'm just not really seeing it. You're starting to get a little bit of a rejection of the 50 SMA, the blue moving average on your screen. If we do start to pull back, the gaps close underneath from 172.80 down to 170 flat, and then anything underneath that. This is a big retest level because that's ultimately where the bottom was formed. Right? The break gap up over these equal highs at 165.55 is the ultimate gap close. Just understand that that's far extended through the lower bound of this week's expected move. I wouldn't be surprised to see the Russell really start chopping around in this as a previous range. You want to pay very close attention to 170. The ideal higher low for the inverted head and shoulders is over 170. If you can hold on to that near the lower edge of this week's expected move, that would be the most optimistic look. But once again, as we've compared, it's not even close to the same amount of strength as what we've talked about in the S&P and the NASDAQ. Here's the hourly time frame chart. The moving averages will be incorrect because I have not reset them here in front of your very eyes, but I do just want to quickly throw on a Fibonacci from the bottom to the top. Where's your 38.2? Yeah, look at that. So perfect. Aligning almost with that 170 is the 38.2 pullback. So all the same concepts really apply, where a double top here, breakdown through the neckline, gets you to this area in the first place. If this holds, that's where you have to see the reversal. So let's just draw it in proper, something that looks like this, and then a double bottom down here. That's what you're looking for if you're optimistic in small caps. If you're not optimistic, you just want to see this level broken down right through. No gap fill reversal, no hold of support potentially at 170.50. Last but certainly not least, we will throw on an anchored view up from the bottom up to the very top, and that's the beginning of the Thursday gap up. So that would suggest that there's room to pull back deeper than this daily key structure at 170. So that's going to do it for the IWM. There are no market internals, unfortunately, over on TradingView for Russell. So let's move on over to the market profile and see what else we can learn from this perspective. So remember that this is that rounded bottom we were just looking at. These are all the equal highs that we broke up and over the gap up on Thursday's session. Value area is lower on Thursday. Major gap up into Friday with decent excess at the lows and a poor high. Notice that the point of control is centralized, so the poor high is in need of repair, lack of material excess or poor high, depending on if it's two across or just one at the top. But point of control, midpoint of the range, same concepts really apply. Opening underneath, and I would start to think about the gap. That point of control, just to give you the number, is at 1767.40. Remember that this trades in 10 tick increments, right? Tenths. And I don't think I give you the number over on the ES, so I just will right now. That's at 4375.50 as your point of control. Let's move along into some deeper supporting evidence. Let's take a look behind the curtain at the weekly performance of our S&P sectors. I took this screenshot after the close on Friday. What you'll notice is that real estate leads the pack here, up 7.9%, obviously extremely rate sensitive there. It's followed up by financials, communications, the tech sector, and consumer discretionary. Everything about these sectors here is definitely heavier weight and more so a risk-on indication. Don't get it wrong, the utility sector, classically D for defensive, and also a lightweight sector, is also towards the midpoint of this pack, and it's up a decent amount, 4.8%. 1.88% is nothing to shake a stick at, but it's not leading per se at the top of the list. At the bottom of the barrel, it's the energy sector, also a lighter weight sector, the consumer staples, which are classically D for defensive, the healthcare sector, D for defensive, XLB materials, D for defensive. So the posture this past week certainly strikes me as being more so a risk-on indication, or at least maybe start to imagine how this could evolve into a stronger trend reversal, which has really been the argument of the entire video thus far. Let's take a look at the structural charts, though, and evaluate what's going on from that perspective. What do we see over here in the XLK? A strong recapture of this area. No lower high up against this, no lower high up against our daily 50 SMA. As a matter of fact, we have an equal high even from a weekly perspective. So not to be, Mr. Pattern here, but there's your double bottom, a break of that level at 172.60 should bring in some sort of continuation in the upward direction, or at least change the trend to firmly being up. The other alternative, of course, is just looking for a higher low over our daily 50 SMA, or a gap fill reversal would suffice as well, around 167.50. The line in the sand I would start looking for is definitely here at 166. Anything underneath that, a little bit more questionable. Where did the strength go, right? If we're underneath 166. Moving along to the XLV healthcare sector, D for defensive, but also second heaviest weighted sector. Remember that it undercut these lows. It made a big time lower low, kind of falling off of a cliff in here. So really thrilled to see the recapture back in the upward direction. It needs to stay sideways, more so up and over that 127. Unfortunately, the inverted hammer doesn't really bode well for that. So monitoring for a higher low, but still very much so in a very clear downtrend, making a lower low. Not thrilled about what's happening here in healthcare, considering it's waiting for the S&P. XLF financials definitely doing some decent work here, rebounding from the lower low up and over the JP Morgan bear flag, Jamie Dimon, I'm going to sell everything breakdown, right? And also up and over the weekly inflection point here around that 33.50. So the more time we can spend above, the better. Unfortunately, because of the thin structure and the nature of coming from the lower low up to this equal high, I wouldn't be surprised to see some sort of pullback here. A gap fill reversal would be ideal around 30, what's the level? Let me just hover my cursor, 33.35. Too many things going on here with TradingView, but you get the idea. A pullback here is very constructive for a shallow higher low and then looking for continuation up and over the equal high. Very, very bullish. Anything deeper, you probably don't want to see it underneath this gap fill area around 32.70 over on the XLF. Straight up continuation seems unlikely, but there's an unclosed gap overhead up towards 34.50. Next up, consumer discretionary still has some work to do. Remember that this has been relatively weak towards the broad market, really falling apart over here in this consolidation range. It was not really participating in the rebound rally, right? The original counter trend rally, at least. And what you'll notice is that we're just in the midpoint of this prior range, so it's really not all that constructive. The ideal look here is a higher low over 156.75. It keeps things more so bullish than bearish. Falling underneath that level threatens obviously the full gap close, and once again the loss of your daily 200 SMA. Here's the XLI for industrials, again in this midpoint of the range type look. Not really all that constructive in here. You've got to get up and over 103.75 to be more so on the bull side of the market. So treating it as somewhat neutral in this range. Now that the lower low has been made, but we're trading slightly higher, neutral through here. I would be much more interested when and if we get back out of this as an overall range. We'll monitor it intraday, but really nothing to write home about yet. Similar story over here in the XLC. The only bullish data point, though, is that this is look below and fail, targets the top end of the range. If we have a failed breakout down here and we can produce a higher low pullback, reattempt in short proximity of time, that ultimately sets up better odds for a break and looking for continuation. So watching 68.40 very closely in the XLC. We might have had 68.50 over on the Thinkorswim charts. You get the idea. The top of the range breaking out. Very constructive for the broad market. Next up, XLP for consumer staples, rejecting our daily 50 SMA, pulling back to close the gap on the Friday session. Ideally, it finds a higher low. We still want upward pressure acting as upward pressure, just not outperformance from the XLP. We want to see it stay over 68.15. If it does continue in the upward direction, obviously that's helpful. The next big test is way up here at 71.30, the origin of the breakdown. Here's the energy sector, much more so sideways in an overall range in the lower third, and as long as we're potentially attempting a lower high underneath 89, doesn't give me a warm and fuzzy feeling inside, but if it can at least stay neutral because it's such a lightweight sector, as long as we avoid breaking down to a big new lower low, I would give it the benefit of the doubt and say it's not really impacting our broad market. Here's the XLU for utilities, making almost the full rotation to the origin of the breakdown, the big old capitulation over here, and breaking out up and over this level. So to me, strong odds for a higher low over 60. If it starts to outperform aggressively, if this thing just starts taking off as tech really starts lagging and the market's holding up, that would be a fairly straightforward short indication if the rally is only being sustained by outperformance in utilities real estate. Lighter weight sector still underneath, lots of overhead supply, rate sensitive, making a higher high in here from that perspective. So giving it the benefit of the doubt, higher low is constructive, but as long as we're underneath this, very difficult to say, okay, it's all good to go over in real estate materials. What's going on from this point of view? Tagging up to the top of this prior range. Again, a pullback in here being inside of this prior range. Wouldn't really think too much of it considering the lightweight nature of materials. And last but certainly not least, we have the SMH for the semiconductors. Big recapture, right? We had talked about how this was looking almost detrimental with the bear flag underneath making a lower low over here after this failed reattempt to get back into the overhead range. This is a saving grace. I mean, not for nothing, but the rally from last week, it really is a saving grace for the buyers right now, allowing the opportunity once again for a higher low attempt. So what do we want to see here from a weekly perspective? Very similar to the S&P, or I should really equate it to the NASDAQ, but a higher low around 143.75 or better really keeps this on the table for either neutral consolidation, and thus the door is open for a, I don't want to call it strong broad market, but at least neutral broad market, not falling off of a cliff. Let's take a look at some specialized ratios. If you ever get lost as to what we're looking at, you can see it in the watch list over here. You can see it in the price tag here, or you can also see it in the top left-hand corner of the overall chart. This is the tech sector relative to the S&P, and you can clearly see the flat top. If that breaks out, that would be an incredibly risk-on indication for the broad market, watching that closely into the coming weeks worth of trade. If we do see a deeper pullback, watching to see if we can continue this higher low look and build out an ascending triangle. Here's financials relative to the S&P. Certainly much more of a bearish look in the lower portion of the overall trend, but if we're going to become constructive, a good first step is looking for a higher low and spending more time up and over the daily 50 SMA. Don't get me wrong, it's definitely not a bullish indication yet. It would be much more helpful to break this range in the upward direction. It's keeping us honest and not necessarily overly bullish, looking for a full-blown risk-on rotation. Here's consumer discretionary relative to the S&P, certainly an opportunity, once again keeping us honest for a lower high underneath the top, or I should say underneath the bottom of this overhead supply. So that certainly would not align with a risk-on look. You really need to recapture that if the broad market's going to see a stronger move. Next up is healthcare relative to the S&P. This is actually helpful from a risk-on perspective because, as we know, when this is moving lower, it does not speak to a risk-off rotation. If this was breaking out of the box in the upward direction, that would be a much more concerning look. Here's utilities relative to the S&P. Overall, still in a downtrend. Similar story over here in the XLP. D for defensive relative to the S&P is technically in a downtrend. None of this would really speak to a full-blown risk-off style look unfolding that we currently have. If we broke this for a higher high after a higher low, that would start to become more of a concern for, okay, let's not trust the move in the S&P 500. Let's move along and take a look at tech relative to utilities, so risk on versus risk off. Really would have expected a bit more here out of the XLK relative to XLU. The fact that this is still in the midpoint of this as an overall range, not really doing anything impressive, gives me some reserved expectations of what to be thinking about for our S&P. Here's the XLK relative to short-dated bonds, and this is basically risk-on versus the most risk-off you could get, short-dated government-backed bonds, right? Equal high here, indicating a preference for technology risk assets, right? So think back to the QQQ with the lower high. The fact that this has an equal high would actually be a slightly positive divergence. Now, if it broke to a major higher high, somewhere in here, up around this 2.2, I mean, that would be a rainbows and butterflies risk-on style look. We don't have it yet, and this has been a fairly sharp ascent. Some sort of higher low pullback is the next constructive look out of this particular ratio. Here's something a little bit more apples to apples, XLY over the XLP, consumer discretionary, consumer staples. This also is keeping us honest, only in the midpoint of this range, not breaking to a new higher high. To be much more risk on, you would want to see it over the top. So the most impressive looking ratio is tech relative to the S&P. It's got some work to do to break that level in the first place, but we have some decent looks to begin. The rest of the list is really keeping us honest, but not necessarily in a full-blown risk-off style look either. Let's move along and take a look at the dollar, see what's going on from this point of view. Here we go back on over to our candles. Beautiful. We're breaking down breaking down in the dollar, as we know, potentially gives upward pressure for equities. And this does make sense with what's been going on in the broad market. The more time we can spend underneath 105.50, the more constructive that would be for a sustained move higher in the S&P. Some sort of lower high underneath and a continued drift to the midpoint of the range. Definitely constructive for a higher equities market. Let's take a look at the gold. This isn't the gold contract. This is GLD, the ETF. But you get the idea. It didn't really, like a little mild pullback here. Remember we were tracking 2030 over in the GC gold contract. Mild pullback off of this level, but still hanging high and tight. That to me is fairly interesting. If this continues to push in the upward direction, furthering downward pressure on the dollar, it would make sense once again that equities can move slightly higher. Let's take a look at silver. Same song and dance, but just not really getting a break back down underneath 2050. I can't remember the exact level on the silver futures contracts, but you guys remember this big flat bottom, right? We broke down aggressively, have recaptured, and we're holding that for support. So the story is still making sense. Let's take a look at some yields. We're going to actually end on the 2-year. We're going to start on the 10. Remember that 5% has sort of been the top of the move. There's still an opportunity for a weekly higher low pullback at this point on the retest of the 2022 high back here. So I'd be keeping an eye on a 4.33 if this protracted pullback continues. But notice that we are starting to get a little bit of a hammer. You don't want to, classically apply technical analysis to interest rates, but the idea still stands. If you're tracking bonds, for example, it would be the inverse, right? So it wouldn't be unreasonable to see rates resume a move in the upward direction. The overall trend here is certainly up, and we can afford a weekly higher low. Don't get me wrong. From a daily perspective, breaking to a lower low means that it might not be unreasonable to just consolidate neutral in this as an overall range. Remember that the next overhead target over 5% is 5.3 technically. Let's take a brief glance at the 30-year. You can see the same old song and dance, hammer right off of the 50 SMA again. Not that you would classically apply technical analysis, but equal low potential for just chop in this range and longer end of the curve remaining elevated in the grand scheme of things. Now we can take a look at the 2-year, and we're going to skip the Fed tracker tool today, but what you'll notice is it's pulling back aggressively. And remember that the Fed funds rate basically follows the 2-year yield, and as this pulls back aggressively, it would sort of be an indication that, all right, guys, the Fed is done. I'll put a screenshot now. Of what the tracker tool is showing, but we're not going to head there today. Let's move along and take a look at the risk appetite of the market through the lens of the TLT ratio to the S&P first. We'll flip back on over to a line chart still underneath our descending trend line. So overall, we are not seeing a classic flight to safety style move unfold. There is no break of the trend line when and if it does happen, because we are starting to build a little bit of a base here, pseudo inverted head and shoulders. If we break, we will certainly maybe change our tone a hair, but we're not there yet. And you can also take a look at our bonds in relationship to one another. Sharp pullbacks into the end of last week with what's going on with rates, the unemployment rate, and the comments from Powell and the FOMC. The other big driver was the QRA and what happened with the Treasury, right? There's less issuance than potentially expected, therefore demand for bonds goes up, and what has to happen with rates, they ultimately come down. With a lower rate environment, generally risk assets can perform better, which is why you're seeing those large breaks in the broad market, basically. So SHYIEI pulling back to the trend line, IEI-IEF to the trend line. The primary trend is still down here. So there's still some work to do. Don't get me wrong. It's not that these things have broken down from their trends, but they're at least threatening it, right? Because now the opportunity is for a lower high through the trend line, and then you're looking for stronger continuation in the downward direction. And then the longest duration, IEF TLT, same idea, getting closer to the trend line after making a higher high, any sort of lower high reattempts, and now you're looking for a breakdown here. And that would relieve some pressure. That would be a bullish force for the broad market. Here's credit spreads, IEF LQD, back down underneath this area right here. This is the longer duration, right? So we had already noted that longer duration wasn't aggressively upticking like the shorter duration. So now that we're underneath this last high from here, that actually looks far more constructive as a bullish indication for the market. Credit spreads are tightening actually in here. Let's take a look at the SHY-HYG, and this is the one that we had the most concern over with this big break in the upward direction. Look at where we're trading. Right back at the prior high. So all of that, widening of the credit spread has been tightened right back up, and that's always much more of a bullish indication. If we look at HYG in isolation, let's just reset that chart view. Remember that this is a daily chart, right? Usually we look at hourly increments over the S&P, but just look at this from a relative basis. Remember how we were saying as soon as this breakdown occurred, right? Okay, that would represent the S&P directionally needing to move lower because the S&P on a relative basis is trading out here in terms of this range. So in the grand scheme of things, this was a massive red flag, a major divergence. Now we're back in the midpoint of that over in the HYG, a massive step in the right direction. And once again, primarily driven by what's been happening with the QRA and the Treasury really restricting the amount of issuance. Let's take a look at Bitcoin, see what's going on from a Bitcoin perspective. We can go back over to candlesticks now. And what you'll see is a massive breakout over here on the daily. That breakout is holding. And as we know, Bitcoin is definitely more so a risk asset instead of a risk off asset. It's been outperforming the entire time. Not bad here. It would speak to financial risk taking in the overall market. Let's take a look at market breadth, new highs versus lows. What do we see over here? Let's go back to a line chart. Let's turn off those moving averages perhaps. We don't really need those anymore. And we will zoom out here to a weekly. Big recovery. This is worth talking about, right? We were talking about green shoots in the intro. Talk about a move up and over the zero mark. That's a strong indication. To come from negative into positive in 1 week's worth of trade, definitely helpful to the bull case and saying, hey, this is not just a bull trap. This is turning into potentially a daily trend reversal. This is helping that case. Next up is SPX A50R. It's called something different over here on TradingView. Still underneath the, this is the 200. SPX A200R, stocks trading above the 200 SMA. You can see that denotation up here. Still underneath the 50% mark, but back over this prior high. So that's a helping, prior low. This is a helping indication, but it's not all the way there yet. Let's take a look at this. This is the SPX A50R, and we want the daily time frame chart over here. The higher low held, and look at where we're trading. Right back to the 50% mark. So this is constructive. The higher low in my eyes is constructive considering the lower low that we got over in equities. Continuing along to the RSP, let's go back to some candles here. Remember that if we were getting more price acceptance underneath this area, the Thursday gap up really saves this. The October low is the next structure closer to 128. Now we're trading back up towards these equal highs. Don't get me wrong, it's not out of the woods. There's still the big retest of this breakdown point over here. We've got to clear this hurdle first, but at least the threat is no longer as prominent for a move into the October low. So in terms of market breadth, it's a step in the right direction. You want to see it continue to improve here. QQQE, equal weight NASDAQ, right, is actually above its breakdown point over here as of Friday's close. That would also be a very constructive look. The more time we can spend above, the more meaningful it ultimately becomes. If we start rejecting that and spending more time down here, you start to think twice, and maybe you're headed back down to these lows around 63. This, as we know, is the AI mania breakout, so the fact that we're back above that is constructive, as we pointed out, but it becomes dangerous if we really can't spend more time over this horizontal level. 7450 is the number in case you're concerned. Next up is the Dow Jones Industrials over Transports for Dow Theory. Notice that industrials are at this breakout point, whereas transports are still lagging. Right? Industrials are up here on a relative basis. Transports are still underneath the bottom of this range. This, once again, is one of those data points that needs improvement if you're a bull, or keeping us honest and saying, okay, we're not out of the woods yet here. There still is an opportunity for a lower high path and continued lower prices. We're not all the way there yet, but strong improvements have certainly been made. Let's take a look at volatility with the VIX. What's going on with the VIX? Right back down to the 15 handle after spending a couple of days up and over that 2050. Remember that capitulation style bottoms are usually way up here around 35. We never really got close. This never really boiled into something that was really, really aggressive. The more time we can spend at or around 15, the more comfortable the market ultimately is. And if we take a look at the VVIX, volatility of the volatility index, remember that this is always the precursor. We're back down underneath 103 firmly. We're actually extremely close to complacency zone based on what has happened. And the big takeaway here, hopefully you've made it until the VVIX, because look at what happens on Thursday and Friday. Is Thursday and Friday the day where the VVIX breaks down aggressively when the market's breaking out to the upside? Absolutely not. The VVIX is breaking down aggressively on Monday, Tuesday, and Wednesday. Right? So this is not just a volatility destruction move from what happened on the Thursday and Friday gap ups, which is fairly important in my viewpoint. If you take a look at volatility futures, they are moving away from a backwardation. Remember, backwardation is over the zero line here. That is when we have inverted risk, more risk in the present day than some point in the future. Underneath the zero line, we have less risk in the present day than some unknown point in the future. This is the skew that money managers ultimately want to see to allocate capital to the markets, and that is going to be helpful from a bull perspective because it's volume inflows, and we are seeing that supported by the NYSE internals. If you've made it to this point in the video, let me know if you prefer the Thinkorswim original presentation or today's updated TradingView presentation. We only did this because the platform is down this week, and for migration over to Schwab, it will be live for Monday's trading session and will likely flip back over, but it was an interesting experiment nonetheless. In Apple, your major pivot is here at 174. That's exactly what we opened up on the gap down from earnings on Friday's session. If we can stay above, a break of these equal highs sets up the rotation to the top of the prior range here at 179.75. If we get an intraday lower high under 174, you could treat this as an hourly double top. That would be your neckline. So a lower high underneath opens the door for the breakout point at 170.75. If we do fall more aggressively underneath our daily 200 SMA, it's fairly difficult to not envision this as a bearish setup with some sort of descending trend line in force. And again, a failure to hold that 200 really puts the equal low on the table at 166. Breaking the trend line, getting to the top of the range, and then offering a higher low pullback is far more constructive for Apple walking forward. Next up is Microsoft. Speaking of constructive, talk about this chart. I mean, my goodness, big 100% round trip retracements all over the place. Earnings gap up, full retracement, and some now. So it's difficult to chase the new money long, but you could clearly make the argument that any pullbacks over 345.75 are constructive here, looking ultimately for the equal high set back here at 361.75. Failures underneath 345.75 are not the end of the world because you can still produce a daily higher low, ideally here at 340.50, right? Lows, higher lows, some sort of higher low here as you really start to get, I would say the line in the sand is definitely 335.75 because it's the top of this prior range. So that's actually my updated analysis here in real time, 335.75, line in the sand for your daily higher low. Moving along to Google, what do we see over on Google? The gap overhead is menacing. It's a wide open ocean. You do not have to be the first one in the door. Any sort of hourly uptrend that develops over 129.50, there is plenty of range to be trading for in the upward direction. Don't feel like you have to be the buyer as soon as you see 129.51 hit the tape. Any consolidation in here is constructive for a pseudo sort of cup and handle, something that's bullish. Higher consolidation is ultimately what we're looking for as long as it's over this breakout point here at 125. Kind of good to go on the bull side for Google. The bears, of course, want to see consolidation that breaks for a lower high underneath. You're retargeting that area and then probably looking for downside depending on how long the duration of consolidation was. If we go sideways for a week or two, yeah, a breakdown lower high underneath, you're probably going to start thinking about the equal lows, especially if the broad market has proven that it's just a counter trend move and it does not materialize into a constructive daily trend reversal. Next up is Amazon. A little bit of lackluster activity, not going to lie, on the Thursday and Friday session, but I mean, not for nothing. Look at what the earnings gap did. Look at what the follow through was after that. So a little bit of pause here is not really all that unreasonable. Any higher lows are definitely good to go out of Amazon anywhere up and over this 132. I mean, even the lows of the Thursday and Friday session, let's go to the hourly chart together and pick off where that reversal might be. I mean, you're talking about 137 flat. Anything that's over 137 flat is also fairly impressive, right? That's extremely high and tight consolidation for the daily time frame and definitely sets up a bull flag breakout, a 2-day balance range breakout, something that does this. You know, your next clear level is there and then here. So 142.75 and 145.50. To the downside, because this is thin structure, a lower high beneath that 137 could kick off a short to get to here for the daily higher low reattempt. So this would be a scalp, a counter trend move, and this would ultimately look to pick it up back in the upward direction. Next up, NVIDIA. What's going on with NVDA? The short that was never a short, right? We talked about how the head and shoulders was too obvious. Everybody and their sister saw it. Wait for the breakdown. There was the breakdown right back up and over that 412.25. So what's the look now? Any higher lows here over 436.85, very constructive, holding over this previous high, and then looking for just follow through into the next overhead targets, 461.50, 474.50. If we do get a lower high underneath 436.85, the gap close is the primary target here at 423.80. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? Ideally, this holds up over 307.75. Remember that this is the range where we absolutely do not want to touch Meta. If we are consolidating above, look at the inside bar from Friday, right? Then that technically keeps the door open for a breakout over 317.25. Walk up your upper targets. If we fall back down underneath, be my guest if you want to trade it in here. I will certainly take the pass on that one. Next up, Tesla. What's going on with Mr. Musk's boring company. It's trying to turn back into the rocket ship here with the gap and go from the Thursday and Friday sessions. Inverted hammer leaves me a little bit skeptical about straight up continuation. In a picture perfect world, we find acceptance over 218.25. That was the top of this high in here. Friday's pullback kind of goes right to it. That upper wick indicates some sort of failure. So I'd be open to the idea that this might pull back, try to produce something that looks a little bit more respectful like that. Everybody's favorite pattern around the channel, the inverted head and shoulders, and then back over the 218.25 becomes the better break to close the gap overhead. So watching what the result of the inverted hammer is quite closely into the early stages this week. Just to give you an idea, the low of Thursday's session is going to be underneath 211.50. And that gap is going to close towards that right shoulder area of potential support. Around 205.50 is the level that you want to use. Next up, last but certainly not least for our core list of companies is Netflix. And what you'll notice is a range has broken out and a range has more than doubled. So that trade is complete from a breakout perspective. And I would say it wouldn't be unreasonable to pull back from the origin of this breakdown over here. Higher lows are the name of the game, as you can clearly tell from the core list of companies. Anything that's over 425.50 is ideal. Technically, we have wiggle room down towards 415. If we're underneath 415, I start to become concerned about this for a major reversal. And then the bigger threat, of course, is the gap close underneath for the longs. Shorts obviously would rejoice in that opportunity, and that ultimately is Netflix. And before we part ways, I have one final trade idea to share with you. ZM, Zoom, of course, is the ticker there. This is everybody's sickness favorite, and it's certainly fallen from grace, but if there is going to be some bottom fishing and the broad market is going to remain constructive, this is a name to be watching for everybody's favorite pattern, the, of course, inverted head and shoulders, or if your preference is to only favor the right portion of the pattern, a bull flag consolidation in this range. Breakouts over 64 have thin structure to retrace up towards your daily 250 SMAs here. The ultimate target from a structural perspective is 67.50. This is in force. As long as we get a higher low over 62.25, it's ideal. You might get a deeper pullback. This looks more similar to the IWM, right? The deeper pullback to 60.50 wouldn't be out of the question to retest Thursday's lows. If it's under 60.50, wipe it off the table. Do not even think about this one. Let earnings pass and then maybe reconsider down the line. That's all I've got for you in today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Appreciate you coming out to the show. I will see you in the pre-market prep live at 8:15 every day this upcoming week. And with that said, I wish you a green trading week.